The markets overall have been soaring this year. This has been led primarily by mega cap technology stocks like Nvidia and other big AI names that are benefiting from increasing market bullishness on the AI boom, as well as the Fed's pivot to rate cuts, and most recently, Donald Trump's election victory to be president of the United States starting next year has also increased bullishness on not only big tech, AI, but also on Bitcoin and other cryptocurrencies, as it is expected he's going to be much more friendly to these sorts of companies from a regulatory standpoint and even from an economic policy standpoint. Meanwhile, it's been a mixed year for high yield stocks. Since July, you've had REITs and utilities experience a very strong rally as interest rates dropped in anticipation and ultimately due to Federal Reserve rate cuts. So far, they've cut by 75 basis points in recent months. It's expected they're going to continue to cut moving forward. So that has provided somewhat of a tailwind, although recently REITs and utilities have pulled back a little bit, especially in a few cases as long-term rates have risen again. But there is one sector of the market that I think has largely been left behind and overlooked by both of these trends, and I think we're going to see a major market reversal here in the near term. That's what I'm going to discuss today, as well as some of my favorite picks to take advantage of this market reversal. But before I get into the video, if you could please give it a like, it'd greatly help in its distribution, help me grow my channel. Thank you so much. Okay, so what is this sector? Well, it's the midstream sector. Not just the midstream sector, but the MLP midstream sector, namely the K1 issuing securities. Now, I know some of you watching may not like K1s or may not even be able to invest in K1s, and that's okay because you can still benefit from this trend by investing in an MLP ETF like AMLP, or my personal favorite, which is the Global X MLP ETF, MLPA. It has a 0.45% expense ratio, has large positions in a lot of these blue chip K1 issuing MLPs, but because it's an ETF, it issues a 1099 instead. Now, you do have to pay that expense ratio. It is 1099 format, so it's a C Corp at the ETF level. So there is potentially a risk of double taxation if you hold an IRA. You don't have to worry about that. And if you hold for the long term, you're not going to worry about too much. So regardless, you can still benefit from this trend and still earn a really high yield. I think MLPA pays out a 7-point-something% dividend yield, which is likely going to continue growing, as I'm about to discuss here. So why do I like the midstream space, and why do I think it's such an opportunity? Well, if you look at the K1 issuing MLPs, they have largely trailed certainly mega cap tech in the broader stock market this year. They've not participated in the recent major rally experienced by REITs and utilities. And even within the midstream space, if you look at the C Corp midstreams that issue 1099 tax forms like TC Energy, Kinder Morgan, the Williams companies, Audiac, many others as well like them, they've all soared recently. In recent months, they've gone way higher, whereas on average, MLP ETFs have not, or MLPs, the K1s, have not kept pace with them. And there are probably many reasons for this. One is, some of those C Corps like Kinder Morgan, the Williams companies, and others, they're known for being leading natural gas players, and there is a major boom in natural gas expected here in the near future as data centers are expecting to rely heavily on natural gas to power them, and a lot of data centers are going to be built, and the ones that are built are going to be demanding a lot more energy as they're trying to power these AI capabilities from some of these mega cap tech companies. And so well-positioned natural gas pipelines near data center development areas and existing data centers, those are expected to see a lot of demand, some incremental growth opportunities, and so those are getting bid up. But a lot of these K1 issuing MLPs also have considerable natural gas exposure. For example, Enterprise Products Partners, on their most recent earnings call, their management team really pointed out that, hey, we're well positioned in places like San Antonio, DFW, which are leading data center markets. They have a lot of high quality infrastructure there, and they should benefit from it. I think Energy Transfer is another one to keep an eye on that should benefit from that as well. And so I think there are a lot of opportunities even in the MLP space where if you're willing to deal with the K1 or simply want to buy one of the MLP ETFs that are rather heavily overweight APD and ET, you can still profit from this data center boom of demand for the midstream space. But you can buy in now still at a much cheaper price, get a much higher starting yield than you would if you were to go in one of these other companies like Kinder Morgan or the Williams companies that have already been bid up. So there's a huge opportunity there. Another reason I really like midstream right now is because, they haven't benefited from the rally largely to the same degree that REITs and utilities have and other infrastructure companies, but they still generate bond-like cash flows because they have long-dated contracts on their pipelines and other assets, and that generates a very stable cash flow stream. If you look at their history, they've been remarkably stable even through economic downturns, energy market crashes, very stable cash flow profiles because they got well-diversified portfolios of assets, mostly investment-grade counterparties. Again, important contracts on very important mission-critical assets. And so these businesses are built like bond-like securities. And so when interest rates are being cut, they should benefit, and their unit prices have not benefited. But at the same time, when you have fears about, long-term interest rates are rising and that's beating down REITs, okay, sure, then the bond-like proxy nature of them does hurt them, but they're not as sensitive to higher rates as REITs are and utilities. And there are two big reasons for this. The first one is simply the fact that energy is known to be a great inflation hedge. Throughout history, when you've seen inflation go up, price of energy typically goes up with it. And also these MLPs have inflation indexed hikes on their revenue that they get from these pipelines. And so if inflation's going up, their revenue should go up as well on an index basis in many cases. The second big reason why I think they're not as sensitive is simply because they have much stronger balance sheets. They are largely independent of capital markets. Yes, they do choose to refinance some of their debt at times and maybe even take on additional debt if they're engaged in some big acquisition or growth project. But in many cases, they can fully fund their growth projects with just internally generated cash flows without having to take on a bunch of new debt. And because they've worked so hard to do that over recent years because of the ESG movement, these MLPs realize, hey, we may not have the same access to capital that we've typically enjoyed. And so we certainly cannot expect to go to the market hat in hand expecting equity. And we really shouldn't expect a whole lot of debt either. And so they have that optionality where they can dramatically reduce their CapEx, they can stop their buybacks, their special distributions, and they can allocate their excess free cash flow after distributions to just paying down debt as it matures, because a lot of these have very well laddered debt maturities as well. And so they can do that as an option if they so chose. Now, a lot of them have really good credit ratings. EPD, for example, has an A- credit rating. So it's able to get debt at really pretty good rates. And so it doesn't necessarily hurt them to refinance debt, and they can use that extra capital to invest in accretive growth projects, buy back units, pay out growing distributions. So they have that optionality. But again, they're not as susceptible to, if interest rates were to spike, they would hold up way better than most REITs and utilities would. Now, what are some of my favorite midstream MLPs, and why do I think that all this together makes the sector such a great opportunity? Well, first of all, it's a great opportunity because, like I just mentioned, it has those dynamics going for it. It's underpriced relative to other midstream companies, the C Corps. It's much more resilient to higher interest rates and inflation than REITs and utilities are. At the same time, it stands to benefit from the AI boom, but it hasn't experienced that updraft in the sector's valuations, unlike mega cap tech, unlike C Corporation, Midstreams, and other AI-related companies. And the final reason is, like I said, their fundamentals have never been better. Their balance sheets are in stronger shape than they've ever been before. They're generating way more free cash flow than they've ever generated before. They're growing their distributions very well right now. Their distributions currently are very safe. Many of them are pivoting to repurchasing units. They're buying back their preferreds to further strengthen and streamline their capital stack. And so they have so much going for them fundamentally. Demand is robust and expected to be strong for years to come, not just due to natural gas, but also other energy needs, because the global economy is simply growing and there's just not enough energy to fuel the boom because there's been an underinvestment in both energy production but also energy infrastructure for years due to fears about ESG, due to people thinking misguidedly that the whole world was going to go green in the near future. We've just come out of, 12 of the last 16 years have been with a Democrat president. And so with that comes tougher regulations on building out new energy infrastructure. And so now that we have a Republican president coming in, they're known for being more supportive of fossil fuel energies, and especially the build out of midstream infrastructure. And I think there's a lot of bottled up opportunities that will be unleashed here in the coming years. And so I think midstream is going to be one of the biggest winners actually from the President Trump administration. And so all those reasons, the valuations are so reasonable, both historically relative to the sector's averages, as well as when you factor in all the positive dynamics facing the sector right now. And so what are some of my favorite picks to take advantage of this? Well, Enterprise Products Partners, like I mentioned, is my top pick. You get a 7% yield, an A- credit rating, very low leverage, strong coverage ratio of the distribution. They have a lot of exciting growth potential ahead of them. They've been making a strategic bolt-on acquisitions. And I think in a couple of years, they're going to have leverage come down, free cash flow bump up, and they can do anything they really want at that point. They can buy back a ton of units. They can issue a big special distribution. They can start hiking the distribution more aggressively, as we're seeing other peers do, or they can go on an acquisition and further grow and diversify the business. Regardless, it should be a major value creating event for unit holders. Another one I really like right now is MPLX. They have an over 8% distribution yield that's covered about 1.5 times by cash flow. They have a very solid balance sheet with a 3.4 times leverage ratio and an investment grade credit rating. Management there said they're comfortable under 4, so they got a lot of wiggle room with their leverage ratio. They are buying back units. They are growing their distribution very aggressively. They just grew at 12.5% this year. They expect to keep doing that for the foreseeable future. So there's a lot to like about MPLX. And then the third one that I really like right now is Energy Transfer. Again, there are many others that I like, but these are just 3 that I'm mentioning here. ET also has a strong investment grade credit rating. They made a lot of progress over the last few years paying down debt. They pay about an 8% distribution yield that's covered about 2 times by distributable cash flow. So they could really accelerate the growth rate of that if they wanted to. Now they're investing a lot in growth, and that's good. They've been also buying back their preferred units, further streamlining their capital stack. And so if you want a little bit more, maybe an investing for growth type business as opposed to returns like MPLX, ET is a good option. They're very diversified, very large. And so, that's another option that I think is pretty good. So hopefully, again, this video added some value to you. If it did, if you could subscribe to my channel, I would greatly, greatly appreciate it. And let me know in the comments below what questions you have, what comments you have, what you think about the midstream LP space moving forward. Thank you so much. See you next time.